$120,000. That is the exact amount of money one retired electrician in Ohio permanently lost because he made a single panicked decision on a single afternoon. He cannot appeal it. He cannot reverse it. He cannot file a form to get it back. That money is gone from every remaining month of his life, compounding into a six-figure catastrophe that will follow him to his grave. Right now, millions of American seniors are about to make the exact same irreversible mistake because of a government report that landed on June 9, 2026, confirming what many feared but few truly understood. The Social Security Trust Fund that deposits your retirement check every single month is now officially projected to reach a $0 balance within 6 years. When that happens, federal law does not allow the government to keep paying you in full. Your check gets cut automatically by 22%, no vote required, no signature needed, no appeal available. Just $456 vanishing from the average retiree's monthly deposit every single month indefinitely. The mortgage company will not care why. The pharmacy will not extend credit. The utility company will not wait. And the worst part is that there is one specific reaction to this news, one decision that feels logical in the moment, that actually guarantees you will receive less money than everyone else who kept their composure and made an informed choice. If you are over 60 and you depend on Social Security for any portion of your retirement income, the information in this video could be worth tens of thousands of dollars to you personally. Everything I am about to share comes directly from the Social Security Administration's own published report, from AARP's official analysis, and from the federal statutes that legally govern your money. Let me show you exactly how this trap works by telling you about Robert. Robert is 67 years old. He lives in a quiet town outside Columbus, Ohio. He worked as a licensed electrician for 41 consecutive years. Every paycheck, without exception, had Social Security taxes deducted. Robert had done his homework. He knew that delaying his claim until age 70 would earn him delayed retirement credits of 8% per year past his full retirement age, producing a permanent 24% increase in his monthly benefit. His full retirement age amount was $2,071. Waiting until 70 would have delivered approximately $2,568 every month for the rest of his natural life. Then the trust fund headlines exploded across every news channel. Robert's neighbor, Mashe, knocked on his door and said, "The government is running out of money. You need to get your payments started immediately before they shut it all down." Fear overwhelmed planning. Robert drove to the local Social Security office that afternoon and signed his claim. He locked in the lower amount permanently. Here is the mathematical reality Robert never understood. The 22% cut projected for 2032 applies as a flat percentage to whatever your benefit amount happens to be at that moment. It does not treat early claimers differently. It does not protect anyone who filed sooner. Everyone absorbs the same percentage from whatever base they built. Robert will receive 22% less of $2,071 for the rest of his life, when he could have received 22% less of $2,568. That difference is roughly $500 per month, $6,000 per year, and over 20 years of retirement, $120,000 permanently surrendered because one afternoon of fear replaced decades of careful planning. There is no withdrawal window remaining. There is no reset button. The money is gone from his future, forever. The law that controls every dollar of your Social Security benefit is the Social Security Act, Section 201, codified at Title 42 of the United States Code, Section 401. This statute established two independent trust funds, the Old Age and Survivors. Insurance Trust Fund pays retirement and survivor benefits. The Disability Insurance Trust Fund pays disability benefits. The law contains an absolute prohibition against borrowing. The Social Security Administration cannot draw from the general treasury. It cannot issue debt. It cannot create currency. Benefits may only be paid from money physically present in the designated fund plus whatever payroll taxes arrive in real time from current workers. The instant the reserve balance reaches zero, payments must be reduced to match incoming revenue. This is not a policy decision subject to executive discretion. This is arithmetic enforced by federal statute, and no political maneuvering overrides basic mathematics. The 2026 Trustees Report confirms the OASI Fund depletion date as the fourth quarter of 2032, one full quarter sooner than projected 12 months ago. At that point, continuing payroll tax collections cover only 78% of scheduled benefits. Every retiree, every surviving spouse, every dependent child drawing from that fund absorbs a 22% reduction on the same day. If you combine the retirement fund with the disability insurance fund, the merged depletion date extends to 2034, with 83% of benefits payable, a 17% cut. But merging requires legislation that does not currently exist. Under present law, the retirement fund stands alone, empties first, and its 62 million beneficiaries bear the full impact, while disability recipients remain fully funded through the entire 75-year projection window to 2100. The 2025 financials make the trajectory unmistakable. Total income was $1.45 trillion, overwhelmingly from payroll taxes paid by 185 million covered workers. Total costs reached $1.61 trillion. The annual deficit of $160 billion was covered by liquidating trust fund assets, which dropped from $2.72 trillion to $2.56 trillion across the year. The 75-year actuarial shortfall now stands at 4.42% of taxable payroll, a sharp jump from 3.82% reported just 1 year earlier. In present value dollars, the unfunded obligation totals $29.3 trillion, exceeding the entire annual gross domestic product of the United States. 3 structural forces accelerated this deterioration. First, the trustees lowered their total fertility assumption from 1.9 to 1.75 children per woman, the single largest contributor to the worsened outlook. Fewer births today means fewer workers funding retirees in 2 decades. Second, immigration projections for 2022 through 2035 were revised downward, reflecting reduced legal admissions and higher emigration, directly shrinking the future payroll tax base. Third, the One Big Beautiful Bill Act, signed July 4, 2025, permanently extended the lower income tax rates from the 2017 Tax Cuts and Jobs Act and added a temporary higher standard deduction for taxpayers over 65. While this delivers modest tax savings to current retirees, it simultaneously reduces the revenue flowing back to the trust funds through taxation of Social Security benefits, widening the annual deficit. Marginally stronger short-term economic projections offset a small portion of these losses, but could not prevent the depletion clock from advancing another quarter toward the present. The payroll tax structure itself compounds the problem. Employees and employers each contribute 6.2%, combining to 12.4%, applied only to earnings up to the 2026 taxable maximum of $184,500. Self-employed workers pay the full 12.4%. Every dollar earned above the cap escapes Social Security taxation entirely. As income concentration grows among earners above that ceiling, an expanding share of national compensation contributes nothing to the system's solvency, while benefit obligations continue rising with each new retiring cohort. 6 dangerous misconceptions are circulating right now, and believing any single one of them could cost you tens of thousands of dollars across your remaining lifetime. The first is that Social Security will disappear completely. That is categorically false. Even after depletion, 185 million workers continue paying payroll taxes every paycheck. That revenue flows in continuously. Benefits persist, reduced to match income. The program continues indefinitely as a smaller version of itself. The second misconception is that current beneficiaries will be grandfathered and protected. The Social Security Administration's own distributional analysis confirms the reduction applies proportionally to every beneficiary on the same date, regardless of when they originally claimed. No grandfather clause exists in current law. The third misconception is Robert's error. Believing early claiming protects you by securing payments before the cut. Claiming at 62 permanently reduces your base by 30% for those born in 1960 or later. The 22% trust fund cut then applies atop that already diminished amount, producing far less income than waiting would have yielded. The fourth misconception is that the 2026 cost of living adjustment of 2.8% meaningfully addresses the threat. That COLA added approximately $56 monthly. The projected cut removes $456 monthly. One covers barely 1/8 of the other. The fifth misconception, and arguably the most dangerous, is the assumption Congress will inevitably intervene as it did in 1983. The national debt now exceeds 100% of GDP. Real interest rates are elevated, and no legislation exists in either chamber designed to close the gap. The trustees explicitly warned that deferring action concentrates larger sacrifices on fewer generations over fewer years. The sixth misconception is that only retired workers face exposure. The OASI fund also pays spouses, dependent children, widows, widowers, and orphans. All 62 million recipients absorb the identical proportional reduction simultaneously. Let me translate these abstractions into the specific dollar impact landing on your kitchen table. The average retired worker receives $2,071 monthly. A 22% cut removes $456 from that deposit every single month, equaling $5,467 per year, permanently extracted from your purchasing power. A retired couple both collecting Social Security averages a combined $3,208 monthly. The same percentage reduction strips $706 monthly from their shared household, which is $8,470 per year, vanishing from their annual budget. The Social Security Administration's own research projects that this magnitude of reduction would double the poverty rate among beneficiaries aged 64 through 78. Approximately 875,000 additional seniors would be pushed below the federal poverty threshold. Women would constitute 62% of those newly impoverished due to historically lower lifetime earnings, caregiving interruptions, and greater reliance on Social Security as a primary income source. Black and Hispanic beneficiaries would represent 42% of those pushed into poverty because systemic wage disparities across their working lives produced smaller benefit calculations. Beneficiaries in the lowest income quintile face a 19.8% reduction in total household income, compared to 5.8% for the wealthiest quintile. Higher income retirees possess pensions, brokerage accounts, and rental income to absorb the blow. Lower income retirees depend on Social Security for 80% or more of their total support. The system's failure concentrates its damage precisely where resilience is lowest. A parallel pressure point converges at nearly the same moment. The Medicare Part A Hospital Insurance Trust Fund is projected to be unable to fully meet hospital costs after the second quarter of 2033, less than 12 months after the Social Security Retirement Fund empties. American seniors face the genuine possibility of simultaneous reductions to their monthly income and their hospital coverage within a single calendar year. A December 2025 AARP survey found 7% of retirees had already returned to work within the preceding 6 months, with nearly half citing rising living costs as their primary motivation. That figure will escalate dramatically once benefit checks actually shrink, forcing Americans in their 70s and 80s to seek employment in a labor market that accommodates them poorly and guarantees them nothing. Here is your 3-step protection plan, and I am asking you to begin this week because 6 years is only valuable if you fill it with deliberate action rather than passive hope. The first step is refusing to replicate Robert's catastrophe. If you are between 62 and 70 and have not yet filed for Social Security, do not allow fear to compress a decision requiring careful calculation into a single panicked afternoon. Every year, you delay past full retirement age of 67 permanently increases your monthly benefit by 8%. 3 years of patience from 67 to 70 yields a 24% larger base. That larger base remains mathematically superior even after a 22% reduction is applied to it. Visit SSA.gov and use the official retirement estimator with your actual earnings history. Consult a fee-only financial advisor who specializes in Social Security timing strategies. Compare the claiming now scenario against the waiting scenario using your specific numbers, not headlines. The single most expensive decision available to an American retiree in 2026 is an irreversible claim filed in reaction to an emotion, rather than in response to a calculation. The second step is building a household financial buffer across the 6 years that remain. If you are already receiving benefits and your claiming decision is behind you, your focus must shift to preparing your budget to absorb a potential $456 monthly reduction without catastrophe. Pull out 3 months of bank statements this week. Categorize every recurring expense as either essential, meaning housing, food, medicine, insurance, or flexible, meaning subscriptions, dining, premium services, secondary vehicle costs. Identify where reduction is possible without threatening your health or basic dignity. Simultaneously investigate supplemental income, part-time remote work, seasonal employment, consulting within your former trade, tutoring, or handyman services can each generate enough to offset the projected loss without demanding full-time commitment. Determine whether you are currently overlooking government assistance you already qualify for. Visit benefits.gov and complete the screening questionnaire for your state. The Medicare Savings Program pays your Part B premium if you qualify, saving over $2,000 annually. The Supplemental Nutrition Assistance Program reduces grocery bills. The Low-Income Home Energy Assistance Program offsets utility costs during extreme weather months. The AARP Foundation provides completely free tax preparation through tax aid and free benefits counseling that routinely identifies hundreds of dollars in annual savings seniors did not realize they were missing. You have received an extraordinarily rare advantage in the landscape of financial emergencies, which is precise advance notice of exactly when the damage arrives and exactly how large it will be. That advantage converts into protection only through preparation, never through wishful inaction. The third step is directing your frustration toward the one institution possessing the legal authority to prevent this entirely, which is the United States Congress. The Congressional Switchboard telephone number is 202-224-3121. Call that number and ask the operator to connect you first to your senator's office and then to your representative's office. When a staffer answers, state your name and city to confirm you are a constituent. Tell them clearly that you are a Social Security beneficiary, that you are aware the OASI trust fund depletes in the fourth quarter of 2032, and that you demand they co-sponsor and vote for legislation restoring full solvency before that date without reducing benefits for current or near retirees. Locate your specific legislators by entering your zip code at congress.gov. The trustees' report states explicitly that earlier action requires smaller adjustments, while delayed action demands dramatically larger sacrifices concentrated on fewer people. If Congress acts today, the payroll tax increase required for 75-year solvency is 4.25 percentage points shared between workers and employers. If they wait until 2034, that number rises to nearly 5 full percentage points. Alternatively, Congress could raise or eliminate the taxable earnings cap, adjust the benefit formula for highest earners, gradually increase the retirement age for younger workers, or combine multiple moderate adjustments spread across generations. Viable bipartisan proposals exist in policy research from economists across the political spectrum. What does not exist is political urgency, and urgency only materializes when elected officials receive thousands of constituent calls within compressed timeframes. A single call takes 3 minutes. Make it part of your Tuesday routine. The connection between your mailbox and your phone is the difference between absorbing whatever Washington eventually decides and actively shaping the outcome that protects what you spent 40 years building. I understand this is heavy information. I understand it generates genuine anxiety about a future you worked your entire life to secure. But consider what you now possess that the vast majority of Social Security recipients do not. You understand the legal mechanism controlling your benefits. You understand the precise timeline. You understand the exact dollar figures at stake for your household. You understand the catastrophic mistake and exactly why it fails mathematically. And you understand the 3 specific actions available to protect yourself beginning this week. That understanding directly converts into money preserved, poverty avoided, and dignity maintained across decades of retirement. The seniors who suffer most in every policy disruption throughout American history are always those who received information too late, trusted assumptions over evidence, and allowed fear to dictate irreversible choices. You will not be counted among them. I'm asking you to do one final thing before this video ends. Share this information with every single person in your life who depends on Social Security. Send this video to your spouse, your siblings, your parents, your neighbors, your former coworkers, and your friends at the Senior Center. They deserve these facts before making decisions they cannot undo. Click the link below this video and join the Global Senior Alerts official WhatsApp channel. Upon joining, you will immediately receive a free Senior Benefits Protection Guide containing a step-by-step process for auditing your Social Security earnings statement, a personalized decision checklist for evaluating whether to claim or delay based on your individual health and finances, and a ready-to-send template letter addressed to your congressional representatives demanding immediate legislative action. Every week, the channel delivers verified updates drawn exclusively from SSA.gov, the Congressional Budget Office, AARP, and the Kaiser Family Foundation, so you are never blindsided by a policy shift affecting your income or health care. This guide and these alerts cost absolutely nothing because 70 million Americans deserve clear, honest information about the programs they funded with a lifetime of labor, delivered while the window for action remains open. Join through the link below, subscribe to this channel so future updates appear automatically in your feed, activate your notification bell so time-sensitive alerts never pass you by, and leave a comment telling me your state and whether you have already filed or are still weighing your timing. I read every comment personally and will point you toward the resources specific to your situation. Protect what you earned, decide with facts, and ensure the people you love see this before fear makes their decision for them. This video is for educational and informational purposes only. It does not constitute legal, financial, or tax advice. Consult a qualified professional for decisions specific to your individual circumstances. All data cited comes from official sources, including SSA.gov, AARP.org, KFF.org, and the 2026 Annual Report of the Board of Trustees of the Federal Old Age and Survivors Insurance and Federal Disability Insurance Trust Funds, the Retirement Desk.